Hello everyone, thanks for checking out my video. Quick announcement, there will not be any market analysis video next weekend, but I will be back the week after. Alright, so the US stock market tumbled last Friday as the post-election rally faded, likely due to the latest inflation data and Jerome Powell's slightly hawkish stance. On a very rare day, 6 out of the Magnificent 7 fell more than 2% each as a significant sell-off in big tech erased nearly $500 billion in combined market cap from Nvidia, Apple, Microsoft, Amazon, Alphabet and Meta. In case you are not aware, the market has already reversed half of the post-election rally. So, is the post-election rally over? Let's discuss them in this video. As always, do watch throughout the video to find out more. Alright, so last week the stock market saw a notable reversal as the S&P 500 gave back more than half of its gains during a post-election rally. After hitting a record intraday high on Monday, optimism began to fade and the index tumbled by the end of the week. As a result, all three major indexes closed the week with losses, with the S&P 500 dropping 2.1%, the Nasdaq fell by 3.2%, and the Dow Jones declined by 1.2%. The latest sell-off was likely driven by concerns over sticky inflation and hawkish commentary from the Federal Reserve. Market seems to be recalibrating their expectations for future rate cuts. Okay, first of all, let's talk about the latest inflation data. The Consumer Price Index rose 0.2% for October, bringing the annual inflation rate to 2.6%, while the core CPI increased 0.3% monthly and 3.3% annually. Although all these figures came in line with expectations, they remain above the Federal Reserve 2% target, reinforcing the fears of persistent and sticky inflation. This basically complicates the central bank's strategy as they plan out their monetary policy under the new administration in 2025. Next up, in case you're not aware, last week, Jerome Powell emphasized that the ongoing strength of the US economy, a robust job market, and inflation above the central bank's 2% target are allowing the policymakers to proceed cautiously in terms of the rate cut. He reiterated that the Fed was not in a hurry to reduce interest rates, which then casted doubt on the pace of the upcoming rate cut in December as well as for 2025. On top of Powell's remarks, Boston Fed President Susan Collins echoed the same sentiment, suggesting that a rate cut in December was far from certain. As a result, enthusiasm over corporate growth under the President-elect Donald Trump, which had caused the market to rally earlier, quickly faded as investors started to scale back their expectations for aggressive rate cuts in 2025. As the earnings season draws to a close, Nvidia's quarterly results will take center stage in the upcoming week, where we will see a relatively quiet economic calendar. The chipmaker, a key player in the rapid growth of artificial intelligence, has seen its stock surge nearly 200% this year. In the process, it has overtaken Apple as the most valuable publicly traded company by market cap. Why Nvidia's earnings report is important because their performance and guidance will offer key insights into the overall health of the AI industry and at the same time conclude a mixed earnings season for the Magnificent 7 stocks. Just to add, Nvidia's earnings release on 20th November will likely create ripple effects across the share prices of other AI and semiconductor companies. Notable names that could be impacted include AMD, TSMC, Meta, Microsoft, and Amazon. On a side note, investors will also be closely monitoring President-elect Donald Trump's preparations for the office. The coming week is expected to bring a series of Trump nomination announcements as the president-elect selects a mix of business leaders, political figures, and controversial candidates for his proposed cabinet. This will likely bring volatility to the market and certain sectors. For instance, vaccine stocks took a hit following reports that Kennedy may be appointed as the top health official. In addition to corporate earnings and political developments, investors will also look forward to fresh economic data, including updates on consumer sentiment, existing home sales, and housing stats, which could provide further clues about the broader economic landscape. But that said, these reports are unlikely to move the market by itself. Let's now move over to the technical analysis section. Well, the broader market isn't looking that great at the moment with 5 straight red candles in a row and that gap down last Friday. Before I go on, a quick recap. In my previous video, I shared that I was expecting SPY to touch and test the 600 resistance level, and SPY did exactly so. I also mentioned that a test of this psychological level could trigger a larger than usual movement with 585 as the target. Look at the chart right now. SPY is sitting right at 585 as the market pulls back significantly last week. I hope that can earn a like button from you. Anyway, check out the MACD. It is on the verge of crossing down. If it does have a bearish cross this week, I think we can expect SPY to pull back towards 576 to fill that big gap up. If this happens, it's actually quite healthy because most gaps get filled eventually. Therefore, the faster it gets filled, then the better it is and increases the odds of a year-end rally. With that being said, watch out for that 576 support level. This is a double support level formed by the Fibonacci level and the 50 moving average. If we get a bounce here, great. But if we don't, I wouldn't be surprised if the pullback extends to sub 570. But all in all, as long as SPY doesn't break below that blue support line, which is around 561 and 562 area, we are fine. A break below that would mean a sea of red in the market, as it could unlock even more downside. Okay, although I hope we can hit 562 in the next few weeks so that I can pick up more shares, I think the odds are low. Therefore, I may have to step in earlier if the current pullback continues. On the other hand, if SPY can bounce off either the 585 or 576 support level, it means that the bullish momentum in the broader market is still intact and that last week's retracement was just a small little break. A rebound from either of the levels will easily see us fill the gap between 590 and 592. And of course, from there, I wouldn't be surprised if the market continues to march towards a new all-time high above 600. Moving over to Apple. Apple looks like it is in no man's land at the moment. It basically bounced off a decent support at 221, which I highlighted last week, but failed to break above the 50 moving average as well as the resistance level of 227. Since 31st October, Apple has been trading sideways between these two levels, 221 and 227. So for us to say Apple is bullish or bearish, it needs to break out of this consolidation range. And I think it's quite obvious that if it goes below 221, it's bearish. And on the flip side, if it goes above 227, that's bullish. Okay, one potential positive news for the bulls is that the MACD could be on the verge of crossing up. But note that I said on the verge. Sometimes it may reverse down, so watch it closely this week. A bullish cross will likely see Apple go above 227. When that happens, I think more upside could come because above 227, it means Apple has reclaimed the 23.6 Fibonacci level as well as the 50 moving average. This 227 will then act as a double support level moving forward. Above 227, the next resistance to watch is around 232. This is one level or area which Apple has difficulty going above previously. If the broader market continues to take its break this week, then I don't think Apple is able to close above it in the short term. I could be wrong. On the other hand, a close below 221 could potentially see Apple continue to fall towards that tiny little gap at 216. That's where the 50% Fibonacci level sits. This Fibonacci level is a typical bounce area if the main trend remains intact. In other words, if Apple continues to fall below this level, then it is bearish, and the next target will naturally be the next Fibonacci level at 211. At this level, I may consider stepping in to sell cash secure put, which is a bullish move. Let's see how things pan out. But I will not be picking up any of Apple shares at this range, if you are wondering. Moving over to Tesla. Well, in my previous video, I shared that Tesla's upside was limited and the odds of a pullback had increased. I also specifically asked viewers to be very careful if you are chasing the price now, as you could be a little late to the party. Guess what? Tesla pulled back 7% last week. It's actually not very surprising because as with all other parabolic moves up, it is always followed by a significant retracement. Okay, but to be transparent and not to hide anything, I also mentioned that within the blink of the eye, we could easily see Tesla hitting low 300 again. And well, that did not happen because Tesla only went as low as 309 during intraday. Although last Friday the share price actually hit 303 during pre-market, I will still take it as Tesla has proven me wrong. Anyway, what's next? Okay, Tesla is on this mini downtrend with a series of lower highs and lower lows. To reverse this downtrend, Tesla needs to get above 324 and stays above it. Above this level, we don't really have a lot of resistance all the way till 350s range. At the 350s range, if Tesla can take out the recent high of 358, it will be very bullish as the share price may continue to charge towards 364 and 384. These two levels were the highest levels created in April 2022. If somehow Tesla managed to go above them, then I would say the probability of Tesla hitting 400 is very high. But on the other hand, if Tesla's short-term downtrend continues, we can then expect Tesla to fall towards the low 300s range. At this area, watch the 300 psychological level closely. If the bulls cannot defend this level, there could be some panic selling from retail investors. That's when we could potentially head towards the next possible rebound area at around 285. Okay, from here pay very special attention to 263 to 268 area. This area used to be a very strong resistance zone where it got rejected 4 times in the last 1 year. But ever since Tesla gapped up above this area, it has now turned into a decent support zone. However, this also means that it is critical that the bulls protect this area, because if this area breaks, then all hell could break loose, and we could easily drop towards the end of the gap, or perhaps even the 50 moving average, at around 252 to 255 area. Okay, by now you should know that Tesla could move very violently in either direction, so don't blink your eyes, alright? Okay, let's now have a look at Google's chart. I think it's quite evident that Google is facing a bit of resistance at the level 182. It actually got rejected at this level on a few occasions since it went below it in July this year. This therefore makes the technical analysis for the bullish thesis quite straightforward. Basically, Google needs to break above and close above 182 to be called bullish. If we can have a few green candles above this level, I would say the path towards 190 is pretty clear. And if we ever get near 190, then obviously that would then be a very high probability that FOMO investors and Google bulls will push the share price towards a new record high. So you get it, 182 is very important for the bulls to conquer. On the other hand, in my last video, I shared that once 174 support level breaks, there is a high chance for us to fill the gap between 170 and 173. As of last Friday, more than 50% of the gap has been filled. And I do think there is a high probability that we will complete the gap fill this week, especially with the MACD on the verge of crossing down. We just need one more red day to confirm the bearish cross. Anyway, I think I have shared on a number of occasions that I will only be excited if Google pulls back all the way to the 50 and 200 moving averages, which are 165 and 163 respectively. 165 is actually a double support level formed by the 50 moving average and the 50% Fibonacci level. I might consider selling cash secure puts here. Might only, okay? But if Google falls towards the 200 moving average or perhaps even goes below it, that will definitely get me excited. I will very likely step in to pick up shares or sell put options, or both. But of course, if given the choice, I would prefer to buy Google shares below 160. Moving over to Meta. For Meta, I really have to pull out last week's video where I mentioned this predictable range-bound movement by the share price. I specifically shared that if one is able to ride the downside, he or she could earn a decent profit. Look at how Meta pulled back more than 5.5% last week. Do give this video a thumbs up if you have found my analysis useful. Alright, for this week, in terms of the downside, pay close attention to only one level, and that is 536. Give and take a little bit. This level has proven to be a strong resistance level in the past, but since Meta went above it, it has now become a strong support level. Furthermore, this is where the 100 moving average and the critical 61.8 Fibonacci level are. In other words, this is a triple support level. If the broader market can resume its uptrend, then by right, Meta should not break this level. But for whichever reason, if Meta goes below it, I personally think that we could head towards the 200 moving average at around 510. That's when I will look at Meta's valuation and see how cheap it is before deciding whether to step in or not. In fact, 536 could also be an area for consideration. Not financial advice, okay? Okay, in terms of the upside, Meta needs to quickly reclaim the 561 level if the range-bound movement is to be continued. Let's say Meta closes above 561, then I think there is a decent chance for the share price to move above 577 at least. And from there, if we have about 2 green candles above 577, then I think we can expect Meta to go near 600 once again. In other words, it will be following this predictable range-bound movement once again. Moving over to Microsoft. Microsoft's chart is quite easy to read. If possible, you can try to draw this uptrend line, similar to what you see on the screen, the blue dotted line. Below the trend line, it's bearish. Above the trend line, it's bullish. End of analysis. Okay, I'm kidding. As you can see, Microsoft bounced off the critical 61.8 Fibonacci level but struggled to go above the blue uptrend line. Around that area, it is also where both the 50 and 200 moving averages are. I must say, the bulls had a tough time battling at this area before it got rejected last Friday as it fell below all 3 support levels. For this week, the first step for Microsoft bulls to take would be to go above 420 to 422 area. This area is formed by the 50 and 200 moving averages as well as the 38.2 Fibonacci level. If you can do that, don't be too happy yet, because we have done it in the last 2 weeks and got rejected. By going above this 420 to 422 area simply means Microsoft isn't all too bearish yet. For it to be caught bullish, it's really as simple as what I have shared earlier, which is to get above the blue dotted uptrend line. By going above that trend line, it means we could very likely fill that huge gap as well between 429 and 432. So after the gap fill, if it continues to go up, that will be great. But if it doesn't and if it retraces, then watch that blue trend line again. If Microsoft can remain above that trend line, that's bullish. Alright, on the other hand, if Microsoft continues to get rejected by the trend line or the 2 moving averages, then I think the probability of it dropping to around 406 is high. What didn't help is that the MACD is on the verge of crossing down. Again, note it's on the verge, so watch it closely this week for confirmation. Anyway, if 406 doesn't hold, then obviously Microsoft is bearish, and that's when I think we can say hello to 400 again, and perhaps even go near the green support line at around 396. Finally, let's move over to Nvidia. Can you see that nice green dotted uptrend line? This line stretches all the way to early August this year. That's a good solid 3.5 months of run-up. During this period, this trend line got breached very briefly on 2 occasions but quickly rebounded back up. Right now, as you can see, Nvidia is testing this trend line again. Early this upcoming week, if it starts falling below the trend line, don't panic yet. Pay attention to how it reacts to the trend line. If it hovers around it just like the previous 2 times, then there is a chance for Nvidia to bounce back up. And obviously, as long as Nvidia stays above this trend line, it will likely create another all-time high this or next week, and that will bring us to the 150s range. Interestingly, Nvidia actually went close to 150 on 6 trading days in a row, but didn't manage to touch it. In my view, if we ever get to 149 again, this time round, it is very likely we will cross 150. Anyway, that's for the bullish thesis. If Nvidia goes below the trend line with red candles and solid volume, we could easily slide to 135, where the first Fibonacci support level is. Even if this support level breaks, I think there is nothing to be too worried about yet. Personally, I will pay more attention to 124 to 131. I know it's a huge range, but this is where the 50 and 100 moving averages and the 38.2 Fibonacci level are. If Nvidia goes below this area, then the bulls might want to be a bit more careful because we could easily see Nvidia below 120 again. Just one more thing to add for the bulls to take note of, and that is the MACD just had a bearish cross last Friday, so weakness could continue early into this week as Nvidia tests the green uptrend line again. But with all that analysis said, the critical moment still lies with their earnings result and guidance on 20th November after the market closes. I think we can either see 150 this week or below 124. Basically, expect huge movement post earnings. Okay, let's now move over to the options trading section. Just one trade to update this week, which is this cash secure put on Microsoft that expired last Friday, 15 November. The contract was sold on 4th October with a strike price of 380. The thought process behind this trade was simple. Back then, the RSI indicator was approaching oversold level. On top of that, the share price was testing strong support levels formed by the 200 moving average as well as the blue uptrend line. This means that there was a decent probability that the share price may see a short-term bounce or sideways movement. I shared this information in the video linked at the top. Do check it out if you are interested. Anyway, shortly after I sold the contract, Microsoft really rebounded off the 200 moving average and the blue uptrend line as per my analysis. Later on, it did fall back down after it reported its earnings, but it remains above 400 and never went close to my 380 strike price. As of last Friday, which was the expiration date, Microsoft closed at 415, which was way above my strike price. Similar to many of my other options trades, the contract expired worthless and I got to pocket the full premium of about $400 without having to close my position. Alright, to wrap up this video, let's revisit a question that was posted at the start of the video. Is the post-election rally over? The answer is yes and no. Yes in the short term and no in the long term. But that's just my personal view. Let me explain. First of all, the market is currently on a cautious mode for a few reasons that were highlighted earlier. Fading optimism from the post-election rally, sticky inflation, and a more hawkish Federal Reserve. With these factors in play, we have seen some shifts in investor sentiment. The market expectations for aggressive rate cuts have basically faded substantially, and investors are also recalibrating their optimism after the bullish reaction to Trump's victory. To highlight, last Friday's market volumes were elevated, which could be a sign that investors were adjusting their positions and also taking profits off the table while they prepare for further volatility amid ongoing uncertainty about monetary policy and economic growth. The technology sector, in particular, has faced pressure as investors shifted away from stocks sensitive to higher interest rates. Looking ahead, another key focus for the tech sector would be the potential impact of tariffs and Donald Trump's economic policies, particularly his stance on China. Okay, in short, investors are facing a range of unknowns heading into 2025, which could lead to increased volatility in the coming weeks. While the macro environment still supports risk assets such as the equities, short-term market movements may be unpredictable, especially when policies shift under Trump's administration. Furthermore, according to the stats by FactSet, the forward PE ratio for the S&P 500 is currently at about 22, which is well above the 5-year average of 19.6 and the 10-year average of 18.1. This suggests that the valuations remain elevated, which could be a concern for investors moving forward in the short term. But all that said, in the longer term, if Trump's tax plan of reducing the corporate tax rate from 21% to 15% gets materialized, it could result in significant tax savings for top companies and the big tech, which could then push the market higher. In addition to that, as companies' earnings continue to expand and grow with the help of AI, the forward PE could be adjusted downwards. Okay, so to summarize, in the short term, the latest rally could falter a little bit as the market started to take profits off the post-election optimism and at the same time price in a slower rate cut campaign. But I do think that a year-end center rally is still possible. And even if it doesn't happen, I remain optimistic about 2025. Meanwhile, as usual, as the market pulls back, I will be looking for opportunities to snap up discounted shares. to me, short-term volatility and uncertainty is an opportunity for me to build my long-term portfolio. Alright, that's all for this video. Do help me out by tapping the like button if you haven't. I will see you again in the following week. Thank you very much.